The UK is about to launch a game-changing regulation starting on October 7th. For the first time, payment service providers will be required to reimburse victims of authorized push payment or AP fraud up to £85,000. This unprecedented move is aimed at protecting consumers, but it's already causing waves in the fintech industry, particularly among startups. At Fintech's Fair Play, we're closely watching how these changes will impact innovation and the future of financial services. The Payment Services Regulator has set a new standard by requiring compensation to be paid within 5 days. This shift is meant to combat rising fraud, but smaller fintech companies are concerned about the financial and operational strain it will put on them. Some firms may not have the reserves to handle large payouts, and this could lead to stifled innovation and fewer new startups entering the market. Emma Hagan, the incoming UK CEO of Clearbank, has expressed concerns about the original cap of £415,000, which was later reduced to £85,000 after heavy lobbying from banks. While the lowered cap helps, many fintech leaders still fear the financial pressure it will bring. The question is, will this regulation encourage more security or simply burden smaller companies with new compliance costs? Two fintech investors who spoke anonymously shared their concerns that the new rules could push some smaller companies into bankruptcy. They believe that increased compliance costs could make it nearly impossible for startups to survive in the payment space. Stuart McFadden, co-founder of scam support startup Refundee, agrees, noting that just a few large fraud cases could be enough to wipe out a startup's entire funding. The situation is further complicated by the fact that the reimbursement process might initially be manual. A platform designed to manage disputes won't be ready by October 7th, which means fintechs will need to dedicate extra time and resources to handle claims. This added complexity will make it even harder for smaller companies to manage compliance, especially with limited staff and resources. Despite the challenges, the fintech industry knows that action is needed to fight APP fraud, which caused UK citizens to lose £341 million last year alone. AP fraud involves criminals tricking victims into willingly transferring money into fraudulent accounts, making it harder to prevent than traditional fraud. This regulation aims to protect consumers, but many fintechs argue that it won't stop scams at the source. Nikki Goulimis, CEO of fraud prevention platform TunicPay, explained how traditional fraud prevention methods don't work against app fraud. New tools need to be developed to catch these scams before they happen, and fintechs are already scrambling to adjust. Many are investing in call centers and boosting their fraud prevention efforts to meet the new regulations. While there are criticisms, there's also a lot of focus on innovation. Some see this regulation as an opportunity to drive new solutions in fraud detection. However, there's one major critique of the new rules. They don't place any responsibility on social media platforms, which are often used by scammers to advertise their schemes. Fintech companies are shouldering all the responsibility, and that imbalance could limit the effectiveness of the new regulation. As we approach the October 7th deadline, the UK is becoming a testing ground for fraud prevention reforms that could have global implications. Fintech companies and regulators worldwide will be watching to see how these rules play out and whether they succeed in protecting consumers while maintaining a healthy environment for innovation. For ongoing expert analysis of these changes and more, make sure to subscribe to Fintech's Fair Play. Stay informed about the latest fintech developments and how they're shaping the future of finance.